Well, I haven't been paying a whole hell of a lot of attention to financial markets in the past year, really since last March when it became clear that the Fed they had put in a floor in the market. Were all in. They were printing as much money as they could to prop up stocks and bonds and everything else. They have written the federal government a blank check. And things have been pretty stable since then. And by stable, I mean the market goes up every week without fail, and which really isn't stability. I mean, that is a form of volatility. It's just volatility to the upside. And as far as stocks are concerned, that's still the case. However, something is starting to catch my eye, and not just my eye, eyes of other people, and that is the bond market, the Treasury bonds in particular. Because of course, the 10-year Treasury bond is that's your benchmark bond rate. That's your benchmark interest rate for the entire, not just U.S. economy, but really the global economy. The U.S. 10-year Treasury bond rate is considered to be the risk-free rate of inflation, or rate of interest. Now, I have some disagreements with that philosophically, but that's generally how financial institutions regard it. So every interest rate that you pay, whether it's on your credit cards or on your mortgage, is based on where the 10-year is trading. Because the way that the bank looks at it is that compared to the federal government, compared to just going out and buying a 10-year Treasury bond, there's some additional risk to giving a loan to you in the form of a mortgage or a credit card or something like that. And so they charge you some premium over the rate on the 10-year Treasury bond. So when the rate of interest for 10-year Treasury bonds goes up, well, then the rate of interest for everything else goes up too. Because the risk of lending money to you as an individual has not gone down. So that risk premium over the risk-free rate, stays the same, but the risk-free rate is going up. And so rising bond yields puts pressure on the entire economy. And that's true of not just, it's not just mortgages, it's not just credit cards, it's also corporate bonds, it's state and municipal bonds, it's all loans pretty much. And the key to our bubble, as I've pointed out many times before, is low interest rates. It's and not just low interest rates, but increasingly low interest rates. Because as people, take out these big loans at low rates of interest, the only way that they're able to, continue to pay to service that, those loans is by rolling them over. All these corporations, all these homeowners, they really can't pay down their debt, the student loans, things like that. These things just have to be continually refinanced. And so our economy is heavily exposed to interest rates in general. Not only would rising interest rates stall our economy from growing. Our economy is growing at a fairly anemic pace to begin with. So rising interest rates would lead to a contraction. We would be unable to sustain this mountain of debt that we're sitting on if rates rise even slightly. Now, thankfully, rates have not risen enough at this point, for it to really become a problem. The 10-year is only at 1.31%, or 131 basis points as of today. I mean, it has been at that level, in the past, over the past year. This is not, it's not like it's absurdly high. However, it has shot up pretty quickly. It was under 1% at the end of 2020. And I believe back around election time, it was like 0.6%, if I remember correctly. So it's like doubled in the past few months. And this doesn't happen for no reason. The bond market, even though it's heavily manipulated by the Federal Reserve, is still a market. So when the when the rates rise, they're rising for some reason. And that reason, it could be because of the Fed, or it could be because of the private sector. And then if it's because of the private sector, there's any number of reasons why it would be increasing then. So for example, if it's the Fed, it would be, the Fed making the choice, hey, we're going to raise interest rates, or hey, we're not going to spend as much money on QE, we're not going to buy up as much debt, we're not going to inject as much money into the bond market. That would be one way in which yields would rise. But the Fed doesn't seem to be doing that. The Fed is, they're spraying the bond market with a fire hose of cash. Jerome Powell's most recent press conference, or at least his most recent public statements, I can't remember if it was an actual press conference, he pretty much said, hey, we're giving the federal government as much money as they need. Just name your number, Mr. President, and we'll cut you the check. So I don't think that, the issue here really is the Fed. It seems to be, from what I can tell, that there is concern, or at least there's anticipation over how much money the federal government's going to be spending. And that perhaps the bond market is not satisfied even with the commitments of Jerome Powell to monetize the debt. That they don't even think that will be enough to satisfy or to keep interest rates as low as they've been. And if that's the case, there are two reasons why the Fed's action would be ineffective in maintaining interest rates where they are in the face of rising government deficits. Now, the first reason would be that the Fed simply isn't buying enough, that they're just not dumping enough money into the system, and so there's this glut of federal paper, that's the wrong term, of federal treasury bonds coming into the bond pit that has to be financed. And there's not enough money currently in the market to finance all that. And the only way in which that money would materialize is if rates rise and draw in more cash into the bond market. That's how supply and demand works in the bond market. Now, the second possibility is that the Fed is unable to keep interest rates from rising because they're printing so much money to give to the federal government that they're just printing money and handing it to the feds, who then go out and spend it in the market, and that creates inflation. And if you have inflation, the inflation premium pushes up interest rates. There's an inflation premium built into the rate of interest on every loan, because your real rate of interest on anything, your real yield that you're getting out of any sort of debt instrument is the nominal rate of interest minus the rate of inflation. So right now, with the Treasury yields at 1.31%, if the rate of inflation was as low as 1%, you're only making 0.31% interest on that bond. And frankly, inflation is not that low. Inflation is much higher than that. And so right now, 10-year Treasury bond is yielding a negative real rate, but I won't get into that right now. What's important is that you understand is that as inflation rises, that will push up interest rates because the inflation premium will be increasing, and so therefore investors will withhold their dollars from the bond market until yields rise to sufficiently account for the higher rate of inflation. And now, as of right now, in the official numbers, inflation has not skyrocketed, and that's what most of these people use. They don't use stuff like the Chapelwood Index or, shadow stats, which, someone like myself would think are more accurate measures of inflation that are much higher than the official numbers used today by the U.S. government. And so rising rates without a rising official inflation numbers could be representative of the market's expectation for inflation in the future. Again, this could come back to, having this new administration in. You have a unified democratic government that can ram through, most of what it would like. They can ram through a bunch of big spending bills. The Fed has promised to monetize those bills, to just print money out of thin air to fund whatever it is that the government wants to do. And the market might be anticipating that there's a chance that will cause higher inflation. But again, as of right now, rates are so minuscule. Even though the rate has doubled in the last few months, it's still not making a big difference. I think that the time to begin worrying about this will be if the 10-year gets up to 2%. Now, at the rate that the 10-year has been moving, that could happen fairly quickly. So I wanted to get on the record and talk about this beforehand. This is something that must be watched. I don't know necessarily, if this is going to turn into anything, if this is going to be, if this is the start of a long-term trend. But as I've said for years, it's inevitable that interest rates will one day rise. And when that happens, it's going to bankrupt our bubble economy. It's going to bankrupt our government. It's going to bankrupt everything. And we're still a long way away from that. But, this is what the beginning of it will look like. It will look like investors in the bond market starting to become somewhat concerned about inflation, and the yield on the 10-year beginning to rise. And if the 10-year, rises substantially, you will see interest rates throughout the economy rise, and that's going to start putting pressure on zombie corporations, on the real estate market, on all markets, because our economy is so heavily levered. We're extremely vulnerable. So, if the 10-year, for example, got up to 5%, that would be game over. But again, right now we're at 1.3%. That is, pretty darn close to zero. Even 5% historically is not high by any means. But compared to where we are now, that would be an astronomical increase, and the economy could not handle that. So for a while now, until I see the bond market calm down, I'm going to be watching somewhat closely. I might be coming back to this topic if we hit, some of the technicians think that if 10 years able to break out of this current channel that's been in for a while. To me, I'm not a technical guy when it comes to reading charts, but it looked like a bear flag. But it broke to the upside. If the 10 years able to hold on to its gains, if it's able to sustain this move above 1.3%, then there are a lot of people in the market who will be looking for the 10-year to hit 1.5%, and at that point we'll be halfway to 2%. And 2%, again, this is still ways off. But if we hit 2% and we're able to sustain above that, and you break above 2%, then I think things could start to get interesting. I think it'll be interesting to see how any proposed stimulus bill that comes out, how that will affect the bond market. As I've said in the past, the best way, if you really want to create inflation and jack up interest rates in this country, what you would want to do is just mail more and more money to ordinary Americans and tell them to go out and spend it. And as I'm sure you know, the U.S. government, since the inauguration of Joe Biden, has disappointed a lot of people who were expecting, first $2,000 checks, and then they were expecting $1,400 checks, and none of that's come to pass. Perhaps the bond market is worried that Biden will perhaps not only fulfill that campaign promise, but will do much more. Perhaps some of the Democrats could even get their wish of recurring payments. And if you just have the Fed printing out checks and mailing them to every person in the country, that's helicopter money. And so maybe this very slight rise in yields is trying to price in the risk of something like that happening. And so if the Dems come out with their relief bill and it's less generous than expected, perhaps we will then see rates go back down. So that's kind of my attitude that I'm going into this, and that's what I'll be paying attention to. So with that said, if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. If you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.